Are we a go, Stephanie? I can't see any participants yet.
Yes, we're good to go.
Okay. Good afternoon, everyone. Welcome to IPA's Summer of Learning webinar series. Today, we are joined by DWT's Alexandra Barrage. Our members will likely remember Alexandra from her presentation during our Innovative Payments Conference in April, and we are excited to have her back. In April, she gave us a presentation, kind of a stablecoin 101. And today we've invited her back to give us an update. There's been a lot going on in the crypto industry, especially related to stablecoins over the last couple of months. So this is a very timely webinar today, and we're excited for Alexandra to share kind of some updates and hopefully maybe make some predictions for what we can expect over the next several months to year. Just a little bit of a housekeeping item. We encourage participation and questions and comments. If you have a question or comment during Alexandra's presentation, you can use either the chat or the Q&A buttons on the bottom of your Zoom toolbar. I will be monitoring that. And so if there are any questions that come up that are relevant to what Alexandra is talking about at that moment, I will politely interrupt her and ask her question. If it's more of a general question, I'll hold that question until the end when we'll be doing a little bit more of a Q&A. So please think of some questions, and this is a great opportunity to ask Alexandra some questions on some of these issues that impact our members. So with that, Alexandra, I'll turn the time over to you.
Thank you very much, Chris, and thank you to the Innovative Payments Association for inviting me back. It's wonderful to be here. Since we last met in April, lots has happened in the stablecoin world. I'm here to tell you a little bit about that. But first, I'm a partner at Davis Wright Tremaine. I joined the firm last December from 7.5 years at the FDIC, where I was both in the legal department as well as a policymaker working on financial stability and resolution planning issues. Now I'm building a bank regulatory and digital assets practice with my colleagues. And I'm also a seasoned bankruptcy lawyer, over 10 years at 2 different firms. And interestingly, that expertise has become really handy in recent days. So lots of interesting mix of clients from payment companies to banks to technology companies, crypto exchanges, trade groups, you name it. It's a very vibrant practice, and I'm very honored to be part of it. But before getting into details, we should ask ourselves, why are you all here? What's important about this topic? Why are you taking the time during a summer day to learn about this topic? I think it's a fascinating topic. I follow it very closely, but I think the bottom line for IPA members is that it's really critical to understand how this world is developing with the broader view that it's going to modernize payments as we know it. And so you'll see that as a theme of today's presentation. There are risks and there are potential benefits with any kind of innovation. And we're going to unpack some of that, give you a sense for the larger landscape, and then also give you some things to think about. So with that, here's a rough agenda of what we'll be touching on. We'll go briefly over the definition of money and forms of payment. We'll walk through 2 types of digital currencies, stablecoins. We'll touch a little bit on central bank digital currencies. Those are obviously not stablecoins, but often come up in the stablecoin discussion. So it's important that you're all familiar with how that all interacts. We'll provide a policy and regulatory landscape, and then give you some thoughts for how to think about the future of money. Let's just keep going. I know we have about 30 minutes or so. I think, just over the past 6 months, what have we been seeing across DC, across the country, across the globe? I think at a very high level, what we've been seeing is innovation happening rapidly across all sectors, all parts of the crypto ecosystem. But outside of DeFi or decentralized finance, traditional banking is becoming increasingly more digitized. I think many of the members who are banks can relate to to that, there's no federal regulatory framework over stablecoins. That hasn't really changed, although there have been some incremental efforts, even since April, to try and gain some momentum there. It's clear that innovators and actually the general U.S. public, according to a recent Morning Consult survey, want regulations for crypto. That's something that is growing more and more with each day that passes. There are some open questions on how to regulate crypto, which we'll touch on. But I think the interesting point now that we step back and we're in this quote crypto winter, right, with Bitcoin being significantly devalued over the past couple months. Well, how do we think about stablecoins and that part of the ecosystem and how that's developing in parallel with this broader stress in the crypto markets? The first thing we're going to talk about is just defining money. I know it sounds kind of elementary, especially to many people on this call, but I think it's important to get the details right before launching into a more deeper discussion on these cryptocurrencies. So essentially, when we think about money, we think about coins, paper money, and electronic money, electronic payments. Money is a widely accepted medium of exchange for buying or selling goods. It's a unit of account. It's a store of value. It can be saved and exchanged without declining in value. And there's this idea of what's called the no questions asked, or NQA principle, which is, it's acceptable. People accept money. And why is it important to talk about these principles of money? Because the future of money may not share any or all of these characteristics. We're not going to get into Bitcoin or other types of alternative coins, but if we were going to get into that, we could actually have a debate about whether any one of these properties is reflected in Bitcoin. Again, the focus is on a very different product today, which is stablecoins. So in addition to the properties of money, we've got this dichotomy between public and private money, right? In the US, public money is the same as cash, right? And private money is represented by things like bank deposits. So it's a liability of an institution as opposed to a liability of the central bank. That dichotomy is important in differentiating stablecoins from a potential US digital dollar. We'll talk about that more in a minute. Today, we have different forms of retail payments. We've got private money that's denominated by banks. Banks engage in maturity transformation and lending. Stablecoin issuers, as a general matter, do not. So that's an important distinction. But really what this is about, this whole crypto thing, it's got many different, characteristics and goals. One of the primary ones is the decentralization of payments. So basically disintermediating the banking system as we know it. And as you can imagine, that has a lot of really interesting consequences and feedback from both those in the banking community and those outside the regulatory perimeter. But for the most part, what we're still doing today involves private electronic money, which is denominated by banks, and that's sort of the state of play today. I think in the future, stable coins, to the extent that they proliferate also in the retail sector, we're going to see a surge in decentralized finance across the board. Potential bank disintermediation or potential bank partnerships. It could actually cut in a number of different ways. And we'll see some new instruments. We've already started seeing them in the DeFi space, known as stablecoins. This slide is just really meant to illustrate the somewhat archaic and multi-step process involved in processing flows. Many of you are already familiar with this. But I think what's really impactful about these images is the idea that, why are we even focusing on this? What's wrong with electronic payments today? Why do we need digital money? And I think the thesis, which I believe in and I agree with, is that our U.S. system is relatively slow. It's got a number of expensive, kind of elements and intermediaries. It's not necessarily instant, although certainly the Fed has made efforts to address real-time settlement. So it's not a hard and fast rule. But I think what's clear is our current payment system is largely reliant on some legacy systems, payment rails, bank back office, type procedures that haven't really reflected true innovation. And so really what we're talking about is ways to innovate and modernize payments so that they're frictionless, cheaper across a number of different use cases. The extent to which we can reduce or significantly or potentially eliminate these different layers as part of the payment system is really what I think the future of blockchain represents, and the promise that many people who study this closely see. We're talking a little bit about the different types of digital currencies. Again, we're not going to talk about Bitcoin. Ask yourselves as you're learning about this, how can digital currencies make payments faster? Can they support financial inclusion? Can they solve real problems? Because that's really the holy grail. There's a lot of, in my opinion, hype and nonsense in crypto, and sometimes it's hard to kind of separate that hype and nonsense from like the real promise of blockchain. Sometimes the stuff that you read about is only about the crypto bankruptcies or the Bitcoin failures, and that's obviously a very important part of what's happening, but it's certainly not the only thing that's happening. In parallel with the stories that we read in the Journal or the Times or CoinDesk or whatever, is a world that is, I believe, really flourishing in terms of innovation. And I'll talk a little bit more about that. First, we're going to go over some general definitions and types. So stablecoins, what are they? We talked about this back in April, but very quickly, there are essentially four types. The one that we focus on the most, and the one that Congress has focused on the most, is called a payment stablecoin. So that's backed by fiat. That's the kind of digital token that's most popular, whether that value be US dollar or a euro. The principle is the same. It's designed to be one-to-one with that reference asset. It's designed to be backed by reserves that are high quality liquid assets, whether that cash or high liquid or cash like things like US treasuries. There's no regulation that governs all stablecoin issuers in terms of how much they have to have in what bucket, which is part of the tension with the fact that we currently do not have a federal oversight over these issuers. But the largest issuers are starting to be more public about what's backing their coins and the composition of that. So these are some examples of stablecoins. The main ones you've probably heard about: USDC, USDP, and Gemini. And then these are just some other types. I'm not going to walk through each one, but the ones you probably have heard of is actually number 4, the last one with the Terra USD icon. You may remember several months ago, big story in crypto land with this coin losing its peg. This was not a payment stablecoin. Very important to realize that this was an algorithmic stablecoin. It was not backed by anything, frankly. It was just run by this formula. And I won't get into the minutia of how the formula works, but just know that the bottom line is that $60 billion of value was erased and had a number of cascading effects across the ecosystem. So hopefully you're smarter now than you were 30 minutes ago, because now there are multiple different type of stable coins, and that knowing the type is really important to understanding the risks. Stablecoin report last November, very quickly, the regulators got together, banking regulators, marketing regulators, and Treasury, and said, look, we're worried about stablecoins proliferating without guardrails. These are private companies outside of the bank regulatory perimeter. Neither the Fed nor the OCC nor the FDIC oversee what these stablecoin issuers are doing. Bottom line, Congress, you need to do something. This was back November. And the recommendation in this report, one of the recommendations, was that only insured depository institutions should be stablecoin issuers. That made a lot of that got a lot of people's attention. A lot of people felt that was too draconian a recommendation. Interestingly, since November, some things have changed. So a little bit of a teaser there. Next slide just kind of walks you through the stablecoin supply, how it's changed over time. This was as of February. I probably should have updated this slide, but imagine this graph just continuing to go up, because it has, and then it's sort of plateaued a little bit. What we saw after Terra was a flight from algorithmic stablecoins to other types like payment stablecoins. But the bottom line here is it's a market cap of about 180 billion, roughly 38 billion from just over a year ago. So just tremendous rise in stablecoin supply, and the soaring value of stablecoins. These are just some milestones. Different products have been using stablecoins, whether it be credit card rewards or partnerships with different types of credit card companies. The bottom line here is, again, adoption has accelerated across various sectors, and the idea of storing value in a stablecoin is one that carries through all these different use cases. What's happened since the stablecoin report? Well, actually quite a lot. On the legislative side, I mean, this is just a short list. There's actually more on here that didn't fit, but since February of this year, we've seen a number of proposals to try and regulate stablecoins coming from both the House and the Senate. So here you have a very short chronology of where we are legislatively. The most recent developments following our key our fireside chat back in April, back on June 14th, Senators Lummis and Gillibrand, bipartisan proposal, remarkable achievement on many levels, came up with the Responsible Financial Innovation Act. It's a very bold and comprehensive act. It doesn't just cover stablecoins, it covers a wide-ranging number of crypto-related topics. Important milestone. Unlikely anything is going to pass this year. And Chris, you're the expert on this more than I am, but I think most people think that while there's been incremental momentum, we're not likely to see any enacted legislation this year. This morning, the Wall Street Journal reported that the House Financial Services Committee, which, as you know, is led by Chairwoman Waters, has been working on a draft stablecoin bill with Treasury and with the McHenry staff. And we might see a draft of that bill as early as later this week or even next week. What's really interesting about what's been reported is that we might actually see a bill that allows a path for non-bank stablecoin issuers. Now remember, that was not the same recommendation as the PWG report last November. And I say that because it's an interesting trend that's happened over the past several months, where it appears Treasury is taking a more flexible position, that it doesn't just need to be a bank that can issue stablecoins. Perhaps there's a route for other non-banks, again, with some kind of federal regulatory oversight. So that's an interesting space to watch. In addition to legislation, we've seen a number of really interesting papers and speeches coming from top government officials. OCC came out with its semi-annual risk perspective, and the bottom line there was the idea that additional regulatory guidance is anticipated. It was great to hear that it's not just that these products create risk, but they could also create opportunities for banks. I think that idea of promise and opportunity is something that I would say is a kind of a new trend in regulator speak, and I think a very balanced one, which I encourage. Vice Chair, Lil Brainerd at the Fed, she's, I think, very much leaning into the potential for a digital dollar, and her comment from just a few weeks ago was also interestingly balanced, talking about spillover effects and guardrails and potential, potential promise for blockchain. And then finally, Under Secretary Lang, who spoke a few days ago at a conference I attended, reiterated this interesting, what I'll call slight departure, maybe from the PWG report, thinking about non-banks as potential issuers. Now, you could say that's probably where Treasury needed to go if they wanted to get the McHenry folks in line. Maybe that was, a point of flexibility that helps us get to a bipartisan bill. But there could be other reasons. I'm just speculating, but it's an interesting trend. Next, we just have a couple of examples of, states not waiting for federal legislation; they're forging ahead. There are many examples of this, but for one, I've cited here the New York DFS coming out with guidance for dollar-backed stablecoins. So what does this mean? Where are we? there's still some really important questions, ones that we talked about back in April, and more. What are the roles for the states in this? The states are regulating a lot of these money transmitters, stablecoin issuers. Are they going to be part of any federal legislation? Are they going to have any examination authority? What's going to be their role? Big question mark. Timing, we talked a little bit about that. My guess is not this year, maybe not even next year, although maybe end of next year, we'll see. Stablecoins in a future CBDC, are we just going to have more types of money or types of money available? Why or why not? Is one going to grow faster than the other? I mean, who really knows? But that's an interesting question to think about. Will non-bank stablecoin issuers, whether it's Paxos or Circle or Gemini, will they have access to a master account? Very, very interesting, controversial live issue. Custodia Bank recently filed suit against the Federal Reserve because claiming that the Federal Reserve has yet to respond to their master account application roughly 18 or 19 months after it's been filed. So yeah, there's some interesting issues there. And then of course we have a newly confirmed vice chair for supervision at the Fed, who's Michael Barr, and waiting to see what his priorities are, including the extent to which they include stablecoins. So very quickly, central bank digital currencies. This is a picture of a paper that came out back in January from the Fed, asking for comments on a whole bunch of interesting questions, risks and otherwise related to a central bank digital currency. As some of you may know, we've got some early adopters with China and its digital yuan, and Sweden and pilot, and the Bahamas has a sand dollar. A lot of jurisdictions around the world are either exploring or just on the precipice of issuing their own central bank digital currency. Interestingly, Chair Powell, Jerome Powell at the Fed, has stated that in his view, a US CBDC could potentially help maintain the dollar's international standing. So basically what you see here is a definition of a CBDC. It's a form of central bank money. Again, a very important difference from a privately issued stablecoin, right? So it's got, it would have, if we do have one, we don't know for sure, the backing of the federal government behind it. Widely available to the general public, a liability of the central bank, not of a commercial bank. And I think it'll be really interesting to track developments here. I get the sense that Governor Brainerd is pro-digital dollar from her speeches. And I think as part of the executive order that was issued by President Biden not too long ago, we may actually see a legislative proposal on CBDC as early as September or October of this year. Why is that important for IPA members to understand? Well, if the model that the Fed has been thinking about becomes real, it will mean that banks and other payment companies, whether it be, could be the PayPal and Stripes of the world along with banks, they are going to be like the connective tissue between the central bank and retail customers of CBDC. That layer is, in my view, integral to this all working out. And so, again, super important that members understand how this is potentially developing and how quickly it is developing. Here, what we have on slide 18 is just a high-level understanding of where the Fed is now. So they're still doing research and analysis in conjunction with very smart people, including folks at MIT. They're working closely with the Digital Dollar Project, which is a group that was started by former Chairman Giancarlo of the CFTC. They're doing some pilot work with everyday consumers and people about whether a CBDC makes sense. A wide range of reactions, both from the banking industry and the stablecoin industry. I personally think that we'll probably see some versions of both stablecoins and CBDCs coexisting, but it's likely not going to happen for a while on the CBDC front, if it happens at all. So very quickly, just high level landscape. Okay, stepping outside the bubble of 495 of the Beltway, where are we across the world and at the different state levels? So on the federal level, we've got the executive order, we've got a number of proposals we touched on earlier. We've got banking regulators with, frankly, differing attitudes, differing mandates, different levels of openness to technology, just as a general matter. And we've got a focus on Congress to please hurry up and do something, right? The OCC and FDIC have put out supervisory pronouncements on crypto in the form of financial institution letters and also some interpretive letters on digital custody. And so the basic message that I think that the regulators are saying is sort of like, stop banks, what you're doing, tell us what you're doing. And if we take it back and we think it's okay, we may give you a supervisory non-objection. But to me, it's a very much like a stock taking message, like don't keep doing what you're doing until you're closely integrating with your regulator. The states have been very active. They're constantly coming out with digital currency and digital asset type legislation. The lobby there is quite fierce. And we've seen examples of different states legislating, whether it's the New York Bit License or the Speedy Charter out of Wyoming, or other examples that are proliferating. And then even on the city level, we've got a lot of self-identified crypto-friendly cities like Cheyenne, the capital of Wyoming, New York City, Miami, San Francisco, and of course, DC. And what a great place to be. Outside our borders, clearly there's a lot of standard setting work and financial stability focus happening at standard setting bodies like the Financial Stability Board and Basel Committee. What's going to be the capital treatment of digital assets? It's a very hot issue. It's being thought about as we speak. So what does this mean for the future? I think what it means is important to track developments, educate yourselves. We're going to see new retail forms of digital money. It's just a matter of time, but it's still early in my opinion. And I think the use case of financial inclusion and whether that is a real thing or not is something that is incredibly important to folks on the Hill and just the general population. So I think the focus here is going to be modernizing payments. How do we do that? Can we do that with the blockchain? Improving financial access, thinking about this both from a sort of macroeconomic and geopolitical lens. I'm not going to get into the Ukraine case for this topic, for this webinar, but I think it's something that's super interesting that a lot of crypto believers cite as like, see, that's a positive thing. And then again, tracking legislation over the next 2 to 5 years. We talked a little bit about why it's important. I think for members, if I were a member of IPA, I'd be focused on, and actually we are a member of IPA, but if I was an institutional member, I would think about these potentially new forms of payment, ways that retailers will be accepting stable coins in the future. Maybe not algorithmic stable coins, again, just the one-to-ones that we were talking about before. Potential disintermediation of the sort of standard program agreements and cardholder arrangements that we know today, potentially avoiding a lot of fees, and also potentially avoiding frictions. This is just a few examples of some payment companies that have been partnering with stablecoin providers to allow payments in stablecoin from debit card and sort of the on-ramps from that. A lot of interesting innovation happening there. And happening very quickly, by the way. And then just a couple slides before we finish. I get asked this question quite a lot, like who is going to be the winner in all of this and who's not? And that's a very sort of binary question that I kind of reject from the outset. But I think that the sentiment is, what should you think about and what should you follow? So that's how I think about it. The idea of private stablecoin issuers thinking a lot about policy, compliance, and regulation to me is just fundamental to surviving in this kind of twilight zone of regulation where we don't really know where the guardrails are. The more that non-banks try and shoot for best practices, that the same kinds of best practices that banks have to abide by for risk management and governance purposes, to me that is a winning strategy. Those non-banks and banks demonstrating rigorous compliance. On the innovation side, the technologists that are focused on the interoperability across blockchains. And so making sure like a US CBDC can someday maybe interact with a euro so that you're able to send a CBDC or digital currency seamlessly, almost like basically for free. In order for that to actually work, in order for that vision to be realized, the technology piece is really important to get right. I don't think we're there yet. People who are educated about crypto, people who can talk about myths and understand whether they're why they're myths and why they may not be true. Same side of the coin, if you're a tech translator, if you can speak software and then also speak plain English, to me that is a huge advantage, because so much of this is moving fast and is complex. And then the future state, what are we going to see as we continue to track these developments? I think we're going to see multiple forms of money coexisting domestically and globally. I think my children are going to be probably getting allowances, or my grandchildren. I wouldn't be surprised if they were getting allowances in stablecoin. All joking aside, I think we're going to see increased customer demand for digital forms of payment, especially as crypto proliferates. Today, Morning Consult came out with a study that said 1 in 6 U.S. households owns some form of crypto. That's a fascinating statistic. And again, I hope in the future state we'll see more interoperability across the blockchain system that we're in. There's lots more stuff to talk about. I had 30 minutes and I went over a little bit, so I'm going to take a pause and turn it over to Chris, and I welcome any questions you all have. Thank you.
Thank you very much, Alex. That was a very informative discussion and presentation, and we appreciate it. I'm going to start off with a question, and in the meantime, if anybody has any additional questions, please feel free to share them in the Q&A. I want to talk about use cases with cryptocurrency, and one of the main criticisms of certain digital assets is that it lacks a use case that is understandable or sustainable. And I think based on what you've described, I think a lot of people in the industry understand the use case for payment stablecoins, fiat-backed stablecoins. And I think based on what you've said today about the future of money, I think a lot of people would argue that it is a sustainable use case. Do you think the use case for stablecoin gives it more validity than other, I guess, more well-known or more popular digital assets like Bitcoin and maybe Ethereum and others that kind of still have to prove their use case?
Yeah, so I think about Bitcoin and Ethereum as kind of the speculative side of crypto, the stuff that's getting all the attention, and rightly so. I don't think I'm yet convinced there's a use case other than as a private form of investment. And in fact, that Morning Consult survey I mentioned indicated that the folks that are investing in crypto are also huge investors in TradeFi. They're not a traditional finance, so they're not investing in crypto at the expense of the kinds of institutional investments that we're all familiar with. So, but away from the speculative aspects for a moment, to me, I think about the promise of the blockchain as a whole, and then I think about how stablecoins fit in to that. When you're talking about use cases for the blockchain, I mean, there are several. One that I find very compelling is focused on digital identity verification and data privacy. So banks across the board have super high compliance costs when it comes to Bank Secrecy Act and anti-money laundering compliance. And there have been, multi-billion-dollar fines imposed on banks for non-compliance. So the cost of getting that wrong is exceedingly high. I could see the blockchain being used to automate a lot of KYC processes, and if we can innovate in a responsible way to create a secure environment for credentials on a blockchain, we could have, I think, a lot more efficiencies and potentially lower costs as part of the compliance process. And I don't think that would only affect banks; that would affect a lot of other types of companies. And in the same vein, I think we could have consumers potentially empowered to verify their own personal information and only share, what they agree to share on a blockchain model. so that they're not oversharing, or so that they don't have the risk of multiple intermediaries holding their PII at any one given time. That's a compelling use case. A lot of really smart people are working on that, including the W3C, which is the World Wide Web Consortium. They've been doing a lot of work on standards that would govern verifiable credentials on a blockchain. So that's an interesting use case sort of for blockchain at large. Specific to stablecoins, the classic use case is, cross-border remittances, right? And we've seen some leading stablecoin issuers lead here. The World Bank estimates that the average percentage of transaction fees for cross-border remittances is something like over 6%, and that doesn't even include bank fees. That's really expensive, including for a lot of people who are not of means and have to pay a significant percentage of any remittance just on fees. So significantly bringing down that cost, I think, will be very impactful. Another potentially transformative use of blockchain is a wholesale CBDC. So ways for banks to settle with each other, without friction, without having liquidity, without having delayed settlement. To me, that is something we haven't heard very much from the Fed on, but I expect we will, and we know they're actually working on it. We've seen more analysis on the retail CBDC use case. So, is any of this going to pan out anytime soon? I don't think the answer is yes. I think we need more time in development, but that, in a nutshell, is what I would think about as use cases that I think, from what I'm reading and who I'm talking to, have real promise.
Great. I had one last question, but before we get to that, if we even have time for it, we have a question from the chat that I wanted to bring to you. Somebody is asking, so why do blockchains currently run on crypto like Bitcoin and Ether and not on stablecoins that presumably are or could be more stable? What would you say to that question?
So I would say Bitcoins and stablecoins are completely different products just by their characteristics. Bitcoin is a volatile asset, right? You could compare it to a stock, right? You take the risk that your stock value will go up and down depending on a number of different factors, whether it be tweets or inflation or whatever. So that's just inherent in what Bitcoin is, whereas stable coins, at least in the payment stablecoin context, are designed to be something very different from that. They're actually designed to have a stable value, and we know that not all of them do, and frankly, some of them probably should be called unstable coins, not stable coins. So to say that they should kind of be a hybrid of each other, or that they should, I don't know, it's a hard question to answer, just because they're fundamentally very different, or they're designed to be very different.
Mm-hmm. My last question that I'm going to squeeze in real quick before we let you go is kind of born out of some personal frustrations of mine as I read the coverage of the Terra USD collapse from a couple of months ago. And it seemed like in mainstream media, so not financial industry news, but more mainstream media, as they discussed this, the fact that Terra was a algorithmic stablecoin was almost relegated to a footnote. Whereas people in the industry understand that the fact that it was not fiat backed was kind of the whole reason, or explained a lot of the volatility that caused the collapse. Did you notice that kind of mainstream media had a hard time picking up on the difference between an algorithmic and a fiat backed stablecoin, and to the extent that a lot of policymakers didn't really understand the difference? I was on a financial trade group call shortly afterwards, and somebody in the industry said, well, yeah, it's a algorithmic stablecoin. What did you expect? Did you notice that or pick up on that kind of lack of understanding in the media?
Yeah, I did. Although I'd hate to say that all the media is the same. There are some savvy people writing, and they're part of the media, and they got it right from the beginning. In fact, they got it right even before Luna broke its peg, because they were saying this Luna thing is something we need to pay attention to. It's not like what we've seen before. So yes, there was a lot of, again, misinformation, confusion about really what this meant. But if you go back to the November stablecoin report, note that paper only looked at payment stablecoins, and it dropped a footnote like on the 3rd page that said, we're not looking at algorithmic stablecoins. They're not proliferating like payment stablecoins are. So we're just not going to deal with that. And so as we saw legislative proposals over time, only looking at payment stablecoins, one of the things that I noticed and I actually wrote about was, why are we being myopic about that? Because actually there's quite a lot of activity in these other coins that are potentially even more dangerous, maybe not systemic, but would have significant consequences for customers. So, I mean, look, you didn't have to be Nostradamus. You just needed to like understand the different characteristics. But I think the point is, unless you really focus on the facts and the details, you put yourself at risk of maybe not really understanding, but you could potentially put yourself at personal risk if you're investing in things that you don't quite grasp. So yeah, read user agreements, or talk to people who read terms and user agreements, because the disclosures there could significantly impact you. I guess that's one lesson. Details really matter.
Yeah. Well, Alex, we are over time, but we appreciate your time this afternoon, and I think we may have to bring you back in 6 months or so for another update. And 6 months might actually be even too long with the pace of innovation and the way things are moving. But we appreciate your time as always, and thank you for joining us today.
Thank you very much for having me. It was a pleasure.
And with that, we'll close out this Summer of Learning event. I'll just make a quick announcement to our members. We have other Summer of Learning events being scheduled, and so keep an eye on your inbox for those. We also have our Compliance Boot Camp coming up late September in Chicago. You should have already received an email about that with an invitation to register, and there'll be more reminders coming up, of course. So we thank you all for your time and have a good afternoon. Thank you, Alex.
Thank you. Good afternoon.